Welcome to the Deep Dive, the show where we take the crucial earnings calls and investor transcripts and extract the insights that, really reshape market narratives.
And today we are jumping into one of the most talked about calls of the quarter.
That's right, the Q3 2025 results for HA Sustainable Infrastructure Capital, ticker HASI. The call dropped after the market closed on November 6th.
Yeah, and this deep dive is just essential because, look, this wasn't just another quarter. Management came out swinging, calling it the most profitable quarter in company history.
It really felt like an inflection point.
It was. This call showed that their scaling strategy, especially with their co-invest vehicles, is, well, it's fully operational. The market certainly agreed.
It did. The stock shot up, 12% the next day?
12%. So we really need to unpack why.
Okay, let's do it. Let's get right into it, but we should go slow here because, as you know, HASI's numbers can be dense. The headline result was an exceptional beat on earnings, so I think that's where we have to start.
They absolutely crushed it on the metrics that matter most to the street. Adjusted diluted EPS, that's the non-GAAP figure everyone uses for forecasting. It came in at a record 80 cents.
80 cents. And the consensus was somewhere in the high 60s?
The forecast was sitting at roughly 69 cents. You're talking about an 11-cent beat.
That's a surprise of around 16%. That's huge.
It's massive, and it confirms that their strategy of underwriting these higher yielding assets is, it's working faster than analysts had modeled.
And it's important to contrast that with the standard GAAP figures, right? Because they can tell a very different story.
They certainly can. The GAAP diluted EPS was 61 cents. Now you have to compare that to the third quarter of 2024.
Where they were at a loss, if I remember correctly.
Exactly. They actually reported a loss of 17 cents per share. So that dramatic swing, it demonstrates two things. First, a normalization of their business. And second, just immense operational leverage this quarter.
And what about the top line? Revenue also beat, but the figures here can get a little confusing.
They can. Traditional total revenue was about $103.1 million, which was just above the $100.3 million forecast.
So still a beat.
Still a beat. And that's solid, 12.2% year-over-year growth. But because of their complex structure, some providers track a broader sales metric that showed a much higher number, closer to 139 million.
But no matter how you slice it, the real story is in the recurring income.
That's it. That brings us to the metric management is laser focused on, and honestly, it's what drove the market's enthusiasm. Adjusted recurring net investment income, or ARNI.
This is the number.
This is the foundation of their whole growth story. ARNI hit 105.1 million this quarter. You have to just pause on that figure for a second.
Because the growth rate is?
It's a staggering 42% year-over-year growth. So when management talks about compounding, this is the number that proves they're doing it. They're shifting from a slow yield company to a rapid growth platform.
42%. That is validation in flashing neon lights.
Yeah.
Okay, let's turn to the strategy that's supporting these numbers. CEO Jeff Lipson laid out 4 key pillars. What stood out to you?
Well, what's fascinating is just how much confidence they're getting from the macro tailwinds. The first pillar they talked about is the secular growth in electricity demand.
Right. Data centers, manufacturing.
Exactly. Data centers, reshoring of manufacturing, the general push to electrification. It all acts as this accelerating tailwind for every single project they look at.
Which basically means their addressable market is growing exponentially.
Precisely. More demand means their clients have more opportunities, and that translates directly into a higher quality pipeline of deals for HSI.
Okay, and the second pillar?
A constructive capital markets backdrop. They said client pipelines remain highly active. They're just seeing deals come across the table constantly.
Now, the third pillar is where it gets really interesting. They claim they can grow EPS across different interest rate environments. That is a crucial claim for a finance company right now.
Yeah.
How credible is that?
That's where we need to put our critical thinking hats on. The claim is that they can do this through two things. First, underwriting higher yielding assets. And second, having access to investment-grade funding and hedging capabilities that, frankly, a lot of their smaller competitors just don't have.
But wait a minute. We've seen rates jump dramatically. Their debt costs have to have risen. So are they truly immune, or are they just, masking the pain by taking on riskier, higher-yielding assets?
That is the right question to ask. Their defense is that their new asset yields are simply outpacing their increased cost of debt.
So the spread is still healthy.
Right. If they can underwrite projects at, say, 10.5% yields, while their cost of capital moves from 5 to 7%, they're still in great shape, and so far, the numbers are backing them up.
And the fourth pillar was just the breadth of opportunity.
Yeah, pretty much. The sheer scope of their opportunity set, utility-scale wind and solar, distributed energy, and these next frontier segments like renewable natural gas, they're not tied to just one subsector.
Okay, so let's look at the actual scale being deployed, because strategy only matters if the platform can handle the volume.
And their managed assets tell a really clear story here. They grew robustly to $15 billion.
That's a 15% increase year over year.
A solid 15%. And to put that in perspective, in Q3 alone, they closed roughly $650 million in new transactions.
So that brings the year-to-date total to, what, $1.5 billion?
$1.5 billion. And the forward look is even more aggressive. Management now expects transaction volumes to exceed $3 billion for the full year 2025.
Which is over 30% growth compared to 2024.
It is. And this isn't just about emptying the pipeline either.
Right.
Even after that massive deal they just closed in Q4, which we'll get to, the pipeline is still robust. It's standing at over $6 billion.
That gives them huge visibility for the next couple of years.
It really does.
All right, let's talk returns, because volume without disciplined yield is, well, it's meaningless. What are we seeing on the portfolio efficiency front?
The discipline is definitely there. Their overall portfolio yield increased to 8.6%. That's up from 8.1 a year ago.
So, positive drift. That's good.
But here's the critical data point for you, for the savvy investor to really focus on. New portfolio investments continue to be underwritten at greater than 10.5% yields.
And this is the sixth straight quarter they've done that.
Sixth straight quarter. This is the engine that is fueling all their growth.
And that high yield on new business is flowing right through to their overall equity efficiency. This is where you can see the trajectory of the company just fundamentally changing.
It is. Their standard year-to-date adjusted return on equity is at 13.4%.
Which is strong.
Very strong. But here is the number that should stop you in your tracks. The adjusted ROE for the incremental business.
Meaning the deals done since the CCH1 co-invest vehicle started.
Exactly. That number is a remarkable 19.6% year-to-date.
Wow. Okay, 19.6. That's a near 20% ROE on new business. That differential 19.6 versus 13.4, that's the single greatest piece of evidence that this whole platform transformation is working.
It's the clearest possible indicator of their future trajectory.
And it shows where the entire company's ROE is headed.
For sure. And crucially, they're getting these high returns without taking on excessive credit risk. Management was quick to point out that their realized loss rates are still under 10 basis points annually.
That predictability is vital for long-term compounding.
It is.
Okay, we have to talk about the centerpiece of this entire call, the thing that really proves their scaling ability. The SunZia milestone.
This deal is truly transformative. It cements their place in the mega-scale infrastructure space. We're talking about a $1.2 billion structured equity investment.
$1.2 billion.
In the 2.6 GW SunZia utility-scale renewable project. This is one of the largest clean energy projects in North America, and it's officially the largest investment in HASI's history.
That number's just staggering. But the key to managing that size and, mitigating the balance sheet impact is that co-invest vehicle. CCH1.
Exactly. If they had to put all $1.2 billion on their own balance sheet, investors would be freaking out about leverage. But the structure means the initial commitment through CCH1 is roughly $600 million.
So it immediately halves the net balance sheet risk.
Right. And importantly, the project is backed by long-term PPAs, power purchase agreements, with major investment-grade counterparties.
Okay, let's just pause there for a second. For our listener, what exactly does a PPA mean here?
Sure. A PPA is basically a long-term contract to sell electricity. It means the vast majority of the power that SunZia generates is already sold years in advance.
Usually to a big utility or a corporate buyer, like a data center.
That's right. And that contractual revenue stream is why these assets are considered such low-risk infrastructure. The cash flow is highly predictable.
Predictability is vital.
Yeah.
But let's talk risk. A project this massive, it has to carry inherent execution risk. What did management say to calm those fears?
Well, they confirmed the project is moving forward as planned, with substantial funding expected in the second quarter of 2026.
Sure.
But you are right to point it out.
There's always a risk.
The sheer complexity of interconnecting 2.6 GW of power. Delays are always possible. The success of the next 18 months really hinges on HSI navigating these operational complexities. This is the main caveat that's keeping some analysts a little cautious.
Okay, so moving to the capital structure. Beyond SunZia, they're clearly managing both sides of the balance sheet aggressively.
They are. They executed an additional $250 million in SOFR-based interest rate hedges.
For listeners who aren't in fixed income, SOFR is the secured overnight financing rate. It's a key benchmark.
Right. So by hedging, they are strategically locking in financing costs on future debt, protecting themselves from more rate spikes.
That sounds like a smart defensive move to protect their growth.
It is. It's just prudent risk management. And then shortly after the call, they issued $500 million of 8% green junior subordinated notes due in 2056.
Very long-dated capital.
And very smart. It diversifies their capital stack away from just senior debt and common equity, and it gives them this huge pool of capital to fund the green investments we've been talking about.
They also mentioned a one-time thing, the SunStrong residential solar ABS refinancing. Guess just this gain is non-recurring, right?
Absolutely essential clarity on that point. They know the street loves smooth, predictable income. The SunStrong deal generated a meaningful cash distribution and a $24 million gain.
A great result.
Great result, but management had to stress that their primary focus and the driver of their long-term guidance is the recurring ARNII growth, not these one-off optimization gains.
Right. That distinction helps analysts model things accurately. Okay, let's zoom out. Investor context. What signals should we take from this quarter?
First and foremost, guidance was firmly reaffirmed. They're sticking to that 10% adjusted EPS growth for 2025 and the 8 to 10% compound annual growth target through 2027.
So they feel highly confident they can hit that baseline.
Very confident.
And how did the stock stack up against the broader clean energy market? I mean, it had a strong rebound year.
The sector has rallied strongly in 2025, no doubt. And while SSI has outperformed the S&P 500 and the clean energy ETF over the last month, since the print,
it's still lagging on a one-year basis.
It's still lagging both on a one-year basis. And that means there's some lingering investor skepticism priced into the stock, despite this recent momentum.
That lag provides the opportunity, though, doesn't it? The market's reaction to this print was unambiguous. A 12% surge says it all.
And analyst sentiment is catching up. The consensus is a moderate buy with an average target around $39 to $40.
Which implies what, 15 to 20% upside from here?
About that, yeah. It indicates the street is starting to believe this narrative shift from a yield REIT to a scaled climate compounder is actually real.
So if the news was so good, what are the sticking points? Why is the stock still lagging over 1 year? What are investors still worried about?
We touched on them, but they're worth repeating. 1, balance sheet leverage, even with CCH1 helping out. 2, project execution risk, especially on a monster project like SunZia.
And rates.
And finally, yes, despite all the talk, there's still that lingering anxiety about interest rate sensitivity. It's going to weigh on the valuation until they have more quarters, proving that 10.5% plus underwriting yield is durable.
Understood. Okay, now it's time for this segment where we explore the wild but plausible investment ideas from this quarter's data. This is not financial advice.
All right, so based on this Q3 print, the premise is crystal clear. The company is fundamentally succeeding in its transformation.
They're not just a yield play anymore.
Not at all. That 42% ARNII growth, the 10.5% underwriting yield, the successful use of CCH1 for mega deals, it all means the market is mispricing their recurring growth potential.
Okay, so what's the trade? How do we construct a relative value play based on that conviction?
The trade is a relative value play that bets entirely on this narrative shift. You initiate a long HASI common stock position, funded by simultaneously shorting a highly rate-sensitive competitor, or even better, a sector ETF that focuses on the utility-scale renewable developers who lack HASI's advantages.
So we're betting on differentiation. We're going long HASI's investment-grade access and their CCH1 scale and shorting the average player who is, still struggling with financing costs.
Precisely. The key catalyst is the market eventually waking up and fully pricing in that 19.6% adjusted ROE on new business over the next, say, 18 months.
So we're betting on HASI hitting their guidance.
We're betting on them hitting that 8 to 10% EPS CAGR through 2027, driven by that huge $6 billion pipeline and the deployment of that new cheap capital from those green notes. While the broader sector struggles, HSI's unique capital stack lets it deliver superior recurring returns.
If that 19.6% ROE becomes the reality for the whole portfolio, that $39 to $40 price target is definitely achievable. It might even be conservative.
It absolutely is. It's a bet on execution over just, correlation to the sector. Everything rests on them successfully managing that SunZia project funding in Q2 2026. But the evidence suggests they have the tools to pull it off.
So to summarize this record-breaking quarter for HASI, we saw record profitability with adjusted EPS of 80 cents.
Exceptional growth in recurring earnings, with ARNII up 42% year over year.
And the confirmation of their scaling ability, signaled by that landmark SunZia deal and the $3 billion transaction target for 2025.
Management really did successfully mitigate the near-term fundamental concerns with this print. They shifted the focus decisively toward growth.
And here's the provocative thought we'll leave you with. The market is now faced with the undeniable reality of that 19.6% incremental ROE. So if the company continues to execute on this higher return potential, when will HSI finally break its one-year lag against the broader clean energy ETF and trade purely as the core climate infrastructure compounder that management described?
The answer to that question is going to determine the stock's entire trajectory through 2027. Keep a very close eye on those Q2 2026 funding updates.
Indeed. We appreciate you joining us for this deep dive. We'll catch you on the next one.